Hello, everyone. Good afternoon. It's a great honor to have Jay Pelosky with us once again. We have, usually in the monthly, we have a lot of charts and a lot of great stuff to talk about, which we'll cover. But to start, I'd like to hear first, from the black bear. So, what is the story about Jay encountering a real black bear? So, tell us more about that, Jay.
Well, yeah, it was. It wasn't quite the movie version, Roberto, but I was on vacation the last 2 weeks up in upstate New York, in an area called the Catskills, and there were two things that really jumped out. One was the kind of unbelievable coincidence that after writing about the middle way and the middle path between high inflation and deep recession, it turns out that the address of the house that we had rented for the 2 weeks was the middle way. So, I mean, that's just like an incredible coincidence, right? You think
Yeah.
about all the addresses of all the streets, and to have the address of the rental home be the middle way after talking about the middle way or the middle path for months struck me as a good sign. And then 2 nights later, we were around dusk, up on the deck. So the house had a deck on the second floor, and one of my sons looks out and says, "Geez, that's a bear. There's a black bear out there."
Yeah.
And lo and behold, there was a real live bear. So not the market type bear that we've been dealing with, but an actual black bear that was probably a couple years old. It wasn't a fully grown adult, but it was definitely good sized. And it actually, after kind of wandering around a little bit, maybe less than 100 yards from where we were in terms of distance, it actually got up on its hind legs and was clawing at one of the trees, I guess maybe to get some sap or something. But it was really, we had it in our sight for probably a couple of minutes, which was pretty wild. And then the coda to that story was about a week later, around midnight, I heard some noise outside in the deck. And I was alone in the house. My sons and wife had gone back to the city for a day or two. And I hear all this noise and commotion. And I'm like, oh my God, you know what it's like. You're in a strange house in the middle of the country. And I get up the next morning and look and go outside on the deck. And the bear had actually found a way to get up on the deck and had kind of attacked the grill, okay, and was trying to get at what's called the drip pan, where the oil and the gas and the fluids kind of congregate at the bottom of the grill. And so the bear had ripped and shredded the entire cover on the grill and had moved this huge, massive Weber electric grill, probably weighed over 100 pounds, had moved the grill 4 or 5 feet in his attempt to get at the drip pan. So needless to say, it took me a while to fall back to sleep that night, thinking that the bear's smart enough to get up on the second floor of the house, of the deck. Maybe it's smart enough to figure a way into the house. So it definitely made for an interesting holiday and a good story after all these last couple months writing about bear markets to actually have a live black bear, not only on the property, but on your deck, was quite the story. So happy now back in New York City. So there are no live bears in the vicinity, but it's brutally hot. And so I'm happy to be in an air conditioned office and talking with you.
Yeah, and it's hot, everywhere, and with these, I think this can easily be called, the summer of hell, because you had heat waves and basically all over, the northern hemisphere. So yeah, there's a lot of charts, a lot of great charts, and I'd like to go through in the monthly. So one of them is we already talked about before, but it's always good to revisit and that's where's Lehman, where you talk about expectations and how pessimistic the market was in June. So and no wonder we had this the great performance in July.
No, it's absolutely right. I mean, that was one of the tells, I think. There's a Bank of America chart with their fund manager survey showing that people were taking less risk now than they were at the bottom, at the low of the great financial crisis. And to me,
Yeah.
I just don't think we're anywhere near that kind of an environment. I don't think we're in anything like a 2008 environment. I don't think we're anything like a 2001 environment. And I think this is important because as we try to parse through where we're going after the big drop in June and the very sharp rebound in July for risk assets, I think it's really important for investors to try and put the current environment into context. And so for me, the context is we're not in anything like an '08 or '01 environment. And then people going back to the '80s and the '70s, I mean, I guess you can look at those periods of time, but I do think, the shape of economies has shifted dramatically. And so I'm not really sure that a lot of that data is particularly valuable. I mean, to me, when I wrote the executive summary for the monthly, I highlighted that the jobs number on Friday, really suggests that the recession call is premature. We're not going to have a recession imminently in the United States when we're growing jobs at 500,000 a month. And that suggests that the pivot talk about the Fed pivoting to cutting rates is also premature. And for us, what we're focusing on at TPW Advisory is the high nominal growth rate environment that we're in. And this is something, as you know, we've been talking about for months and months. And now we're starting to see others talk about it as well. JP Morgan has highlighted it. Our friend Barry Knapp at Ironsides has highlighted it, and others are as well. And it really it comes to the fore in the earnings picture. So remember, the last piece we wrote, the last musings before going on vacation, was talking about an earnings bridge, right? That earnings were going to bridge us to the point where inflation was rolling over. And in the last couple of weeks, we've gotten through earnings season, pretty much in the U.S. anyway, and that earnings bridge held up. In the numbers, I quoted them in my piece. U.S. earnings were up 10% year over year. In Europe, everybody talks about Europe like it's just a wasteland. Earnings were up 22% year on year. Revenue growth in Europe was up 36% year on year. Revenue growth in the U.S. up 15% year on year. Those are really strong numbers. And so, yes, I know that people have taken down Q3 a little bit and maybe taken down Q4 a little bit. But my point is that we're in a high nominal growth environment, that earnings and sales are denominated in nominal dollars. And so if you're growing a nominal GDP of about 8%, give or take, in the US and Europe, that a 5% earnings growth bar is not a high bar. And therefore, earnings were going to be the bridge to get us to the point where we have inflation rolling over. And so I think that's really the issue to focus on next. Inflation's peak. We have the CPI for July on Wednesday. It looks as if the consensus is for it to be slightly lower on a headline basis than June.
And slightly up on a core basis, right?
And core being slightly higher. And I do think we need to start moving from focusing on the headline number to focusing on the core number, because I think that's where the Fed is going to turn its attention. Excuse me. I did catch a little bit of a summer cold when I was on vacation. So for us, seeing that inflation roll over is really going to be key, because the faster it rolls over, the less likelihood the Fed has to tighten into making a mistake. and really damaging the underlying economy. So that's a key for us. And we really came up and talked about three keys from a tripolar world perspective for the second half. And the first one was the one we just touched on. How fast does inflation roll over, particularly in the US? Because the Fed is obviously the most aggressive of the main central banks. The second, in Europe, is the path of energy prices. You know, what happens over the next couple of months for energy prices in Europe, because that's the key driver to the European situation. And then third, in Asia, is how smoothly does China learn to live with COVID? Because kind of understated and under the policy mix in China, there is this move towards learning how to live with COVID. And I think the smoother that goes, the better the economic data is for China. And remember, that's an important consideration for us, this idea of a desynchronized global economy, where US and Europe is slowing, but China, coming out of its COVID lockdowns, is accelerating. And that difference, that desynchronization, should support the overall global economy. And so those are really the keys as we see it. And that leaves us net kind of constructive on risk assets out to year end. In the near term, markets have moved a lot, particularly equities. So a period of digestion would be healthy. But I think increasingly, you know, from our point of view, we may come to realize that the true bottom for this cycle was back in mid-June.
Yeah, no, it's a great methodology. You know, when you look at those three questions, and of course, I mean, we are really looking for the answers. You know, we don't have the answers, but how much do you think is priced? How do you think the market is pricing these questions? So, I mean, you think there's room for surprises and therefore, you know, upside to the market based on how the market is reflecting these things, such as, you know, U.S. inflation and European energy prices?
I do, and I look at, you know, one of the benefits of being an independent research boutique, as we are at TPW Advisory, is we get to look at a lot of different folks' data, right? When we put those 23 charts and tables into the monthly, there's probably a dozen or more data providers that provide those different charts. So we're not locked into a house view or a particular kind of cohesive, you know, firm-wide view of the world, let's say, as many banks are. I mean, you worked at big banks, I've worked at big banks. We know that the pressure to have a house view, right? One of the freeing things about being boutique is you can have, you know, you can take from different places and assemble your own view. It doesn't mean it's going to be right, but you have more inputs that balance out different points of view. And so one of the firms that we like to use on the issue of what's priced in is the JP Morgan work, which does a pretty good job, I think, of identifying what, you know, percentage of recession is priced into different assets. And clearly stocks priced in, you know, at least a mild recession in June, and now pricing some of that out because, you know, the market is a forward-looking mechanism, right? That's why we always say, you know, we want to let the market tell us rather than we tell the market. The market is looking 3-6 months ahead. And so, you know, bond market told us with its big rally that inflation was coming off the boil. Stocks picked up on that together with earnings being better than expected, and you have the July bounce. Where do we go from here is exactly, you know, you asked the right question. You know, where is the potential for surprise? And I think the potential for surprise is, for the most part, in the upward direction, which is why we're constructing, right? There's room after 4 months in a row of worse than expected inflation numbers. There's room for inflation to surprise on the downside. there's room for earnings to be better than expected in a high nominal growth rate environment. After all the uncertainty in Europe around energy prices and all the question of whether Gazprom is going to, provide 20% or 30% or 40% of shipments, all that, the market is now discounted and taken all that in. And we're only months away from that peak, seasonal pricing, right? I mean, I know it's August and we're all hot as heck, but in 3 or 4 months, it's going to be wintertime. And once Europe gets through that winter period, you could see a dramatic shift in energy pricing, and that's a key factor for Europe asset prices, regardless. Talking about the currency, talking about rates, talking about equities, etc. And then in the case of Asia with China, China, we had the view of 2022 being a glide path year for China. Zero COVID kind of upended that in the first part of the year. But when we think about going forward, the second half of the year, remember the second half of last year was pretty tough in China. That's when the regulatory stuff came out. That's when Evergrande, it was about a year ago when people were really super bearish because of Evergrande in the property sector. So year-on-year comps in the second half for China should be pretty manageable. And so there's room, I think, for upside surprise there. And if you look, for example, how would that be expressed? You look at emerging market equity, been a huge underperformer, right? I mean, in July, S&P was up 9%. ACWI ex-US was up about 6%. Emerging markets were flat to down because China was down, 8% or so. So when you think about that, and you think about, okay, if you're constructive, where would you want to look for something that hasn't moved? Emerging market equity, I think, is something that's climbing up the ladder, so to speak, in terms of thinking about where there might be an opportunity going forward. And so I think you're absolutely right. Downside surprises, we've kind of taken on board inflation. I think we've now discounted that. We've taken on board recession risk. We've now kind of discounted that, right? Stocks and bonds are much more kind of priced in terms of thinking about a recession. And so now the shortfall, as we've talked about repeatedly, the difference between a bear market with recession versus without is about 15%. And that tends to come from a sharp decline in earnings. And that's why we stress at TPW Advisory the high nominal growth rate environment we're in, because we think that protects us against a sharp fall in earnings, at least for the near term. And if we get that inflation rollover quickly, then I think the Fed gets a lot more room to assess how it wants to move forward. And I think at the end of the day, when we're looking 6 months from now, let's say, and let's call inflation in the US running at about maybe 4%, and people talking about the Fed having to drive inflation down to 2%, I think there's real potential for the Fed to kind of declare victory early and accept kind of a 3% inflation rate, arguing that it's better to have a 3% inflation rate and a somewhat growing economy than forcing it down to 2% and pushing the economy into a deep recession, with the argument being that the secular forces of disinflation, which kept a cap on inflation over the 2010 to 2020 period, technology, demographics, things of this nature, still remain, kind of intact. And so the Fed can rest a little easy at 3%, feeling comfortable that by then, let's say Fed funds are at 3.5, give or take, 50 basis points, that there's room for them to cut if need be. And there's room potentially, if they need to go higher, as well. But I think that's where we're trying to spend our time, is trying to game out the rollover, as we talked about, and then the potential for the Fed to kind of sit at 3% without forcing inflation down to 2%.
And just to be clear, Jay, that 3%, where are we going to see it? Is it going to be some core number? Is it going to be whenever the core CPI prints 3%, or is it going to be more looking at inflation expectations, because they are already below the 3% level, right?
Yeah, that's a great point, Roberto, and I should have mentioned that, so thank you for mentioning it. That's the other thing that might allow the Fed to somewhat declare victory around 3%. Exactly your point about inflation expectations. Because the fear is that inflation expectations become unanchored, right? And then, we're off to the races and everything's uncertain. With inflation expectations being anchored, the Fed might have more flexibility as we get to that 3%. And I'm thinking 3% in terms of the Fed's preferred measure, right? So core PCE type measure, not headline, cores. As I said, we want to start shifting our focus now away from the big 9% headline number. We want to focus now on the core, and we want to see that starting to decline. And that should happen in the next couple of months, because headline is gas prices, energy prices, food prices, used car prices. All that stuff has come down sharply. We know that. Core is labor and housing. And early indications are in both those segments that those are rolling over quickly, particularly housing. The 2-month rate of change in the asking price for housing in the U.S. has never been more negative than it is right now in the last 2 months. Housing has fallen off a cliff in the U.S. Labor is obviously takes a little while longer, but if you look at the quits ratio, for example, that's rolled over. That's an early lead into what happens with wages, because the wage gains have been primarily amongst the people who have changed jobs. They're seeing the biggest bump in pay. No real surprise, right? So if the quits decline, the people who are quitting jobs and taking new jobs, their wage appreciation should decline, and that suggests that the wage pressures start to decline. So these are the early indicators that we're watching to see if, in fact, that core number starts to go down. And as that happens, with inflation expectations anchored, I think the Fed may declare victory early and say, look, we're not in the post-09 environment. We're in a new environment that we've called the new world of high nominal growth, led with CapEx, productivity surge, the things that, again, we've talked about for months and months, but now they're starting to manifest. And so we want to, as we move into the second half of the year, I think that we may be starting to move out of this kind of emergency policy making environment that we've been in for literally the last 2 years, right? From COVID to some of the climate uncertainty to the conflict in Russia. It's really been a very, very packed environment with big macro policy issues kind of being done somewhat on the fly with very little historical antecedent to guide the policymakers. Going forward, second half of 22, 23, 24, our view is that we're probably going to move into a more stable, traditional environment where policymakers might feel a little bit more comfortable, again, with the important caveat that it's not going to be the low nominal growth world of 2010 to 2020. It's going to be a high nominal growth world, in our view, akin to the second half of the 90s in the United States.
Yeah, no. This is very clear, and I also had a question. Going back to to your question number 2, which is actually energy prices in Europe. I want to understand, when, because you talk about winter. So do we need to go through winter to make sure there's not a problem? And living in Europe, I share that with you because that's my main concern globally. Not so much about a recession. We all know, there'll be a deceleration, but what really keeps you awake at night is the possibility of political, disruption or whatever. If people have to ration energy, which is something Europe hasn't done, since the war. So, but from your point of view, from your question, is that do Europeans need and do we need to wait until winter is over, or is there such a thing as, okay, let's look at Europe's storage levels, gas storage levels
Right,
in November, and
right.
and depending where they are, can we declare victory? Because I think that's something we should monitor, on a day by day basis, and also looking at renewables generation and how is that's going. So
Yeah,
I just want to know how to follow up and how to monitor this
yeah.
this issue.
No, I think you're spot on. I mean, much as the history suggests that it's inflation's peak that marks the bottom in stocks. It's
Yeah,
not by getting to 4%. It's once the market sees the peak, it knows what happens after that,
yeah,
right? And discounts it appropriately. And I think you're right on it with the energy issue, because I think it's going to be probably quite similar. I mean, everyone I think we're pretty well aware that there's a target ratio of where Europe wants to be in terms of gas storage by the fall
yeah,
to feel comfortable about making it through the winter without any extraordinary measures, as you point out. So I think for the market's perspective, and again, always remembering that the market is a forward-looking mechanism. I tend to think that watching that storage number for that fall kind of cutoff date is really the way to pay attention to Europe, because once we get to that point, then you can have other things start to come into play. The fact that Europe's fiscal situation is much more constructive than the U.S., which is having a pretty tight fiscal environment. The currency with the euro at almost parity is very cheap. With China recovering, that's really good for exports from Europe. So then you start focusing on those issues, and you look at valuation, which is very compelling relative to history. You look at earnings growth, et cetera, and Europe, which has really kind of been out of favor from an equity perspective, certainly, and currency perspective as well, maybe starts to swing back the other way. And importantly, they're talking about the currency. We need to bring the dollar in, because the strong dollar has clearly been, at least to us, has been a surprise. We have been wrong on the dollar this year, but my expectation is that once we see that that inflation has peaked, then I think there's some room for the dollar to weaken, and that would really help a number of things, including non-U.S. equity, of which Europe is a part. But that's somewhat long-winded. Bottom line, yes, I think we want to be watching carefully, as you say, almost on a daily basis, but particularly as we get close to that level, that time and date where Europe is looking for, I forget, 68 or 70% storage for
yeah,
the winter. And I think after that, if we get through that point, I mean, we've already had to deal with the question of whether Gazprom was going to put any gas into the pipeline. We've already, the market's already dealt with that in a way. It's already thought about that. People who are really worried about that are not in Europe, right? So it's almost like China and Taiwan, right? We've had this whole hullabaloo about Nancy Pelosi's visit. Chinese equities, Chinese currency, they barely reacted. Why? Mostly because I think foreign investors are not really heavily exposed to Chinese equity. And so there's not big selling pressure. And I think so similarly in Europe, people who are really worried about the Russians turning the tap off, they're not in European equity. You just look at, again, going back to B of A and their fund manager survey, been like 35 or 40 weeks in a row of outflows from European equity funds. I mean, it's ridiculous.
Yeah, no, and it's I was talking to a friend at a hedge fund today, in Europe, and of course, it's not only that. I mean, there's something that I would say he counts on, but it's part of his rationale, which is a potential peace agreement. So he's buying out of the money calls on the euro. So I would say 110 or I don't know 118, whatever. So because he thinks that if there's any peace agreement or anything, and I really don't have a clue, how likely there is. He thinks the euro can go up, like 6-7%, like this, in a second.
But that would definitely qualify as a surprise, a positive surprise. And again, when you think about the last couple of months, there've been plenty of things to get wrong.
Yeah.
I was of the view that time was not Putin's friend. I still think that way, but here we are, whatever, 6 months into the conflict, and it's still going on. I mean, I do think here too, timing is important, because once winter starts, right, there's not going to be a lot of movement, a lot of fighting. So I do think we're gearing up for probably what might be a pretty important time. And there's talk of a Ukrainian, counteroffensive to push Europe back. And were that to succeed, then maybe there is room for some sort of a peace agreement or a ceasefire or something along those lines, which it would certainly qualify, I think, as a positive surprise, and would be viewed as your buddy says, as a reason to certainly cover your shorts. And as we've seen in different asset prices over the last couple of weeks, when people cover their shorts and there's no reason to sell, prices change direction meaningfully and quickly.
Yeah, I've heard conflicting things on that matter. One, I mean, but that has a while. The first one has been about not wanting to fight beyond mid October, because it's too cold. And then I thought that could mean a peace agreement, but then the story was, no, now the Ukrainians think they can push the Russians out of Donbass. And now, last week, I saw news about Pope Francis maybe going to Ukraine, and then people become hopeful. And the other one was was a quote on Twitter, where Zelensky was potentially asking for Xi Jinping, for help with Russia. So I mean, I don't know, and it's very difficult to understand and to have really clear information about what's going on. So, but it's clear. I mean, I think I agree with you on the three questions. That's a great framework, and I don't know. Maybe it's because I live in Europe, but the most important question is the one about gas prices. And
And I would think, and I would think the gas prices would be the tell on any potential peace deal or anything of that nature, right? That's the thing that's going to respond probably faster than anything else. So again, it goes to your point of paying almost daily attention to the evolution of gas prices in Europe. I think that I know certainly for me, if it's not daily, it's every other day. I check the Dutch contract. And it's something you want to have on your radar screen for sure.
yeah. No, and talking about gas and climate and energy. I mean, at least we have some good news, on the on Biden's climate plan. That was rescued from the dead, because and I remember us discussing here, I don't know, a couple months ago, and we didn't have the hope that this would happen. So it's actually good. I mean, of course, it's not the ideal one, but tell us what had happened, what that means. You, I mean, you can talk about not just the portfolio, where of course, climate is a big thing, but how does because I saw there is a chart in the monthly about what that bill does to the possibility of the U.S. achieving net zero in 2050. I mean, what it means in terms of emissions reductions.
Yeah. Yes, that was again another example of a really useful chart, right? Picture says 1,000 words or 10,000 words, whatever the saying is. Yeah. Well, first off, it was a surprise. The negotiations with Senator Manchin were kind of secret until the last minute. White House was not involved. This was purely done between Chuck Schumer, who's the majority leader in the Senate, and Joe Manchin of West Virginia, who's been the sticking point. And they were able to get a deal done that, importantly, is while much smaller than the Build Back Better bill originally was, which was in the trillions. This is in the hundreds of billions. The vast majority of the money that had been kind of set aside or identified for climate is still in. So climate, the money for climate, somewhere around 90% is in this bill, which is now passed or passed in the Senate, and likely to pass in the House without any difficulty. So importantly, that means that the potential, as you asked, for the U.S. to meet its goals is now a real possibility, assuming all this money gets spent and does what it's supposed to do, et cetera. Because all this is obviously, decade more to come. And so I think it's very significant. It means that the U.S. has a role to play globally, can kind of bring others along with it. Yeah. And, we've done it as opposed to, Trump exiting from the Paris Accord and not being able to get Build Back Better. Now the U.S. has a chance to be a leader again here, and together with Europe, which is the clear energy leader, being driven in part by the need of reducing its dependence on Russian gas. So now you have the U.S. and Europe pushing aggressively on climate, and so you can see the reaction of the last week or two with some of the climate ETFs that we hold. Have been quite significant. ICLN, LIT, URNM, Hydro, hydrogen, all of those have had pretty meaningful moves in the last couple of weeks. And as you know, in our TPW20 thematic model portfolio, climate is the single biggest segment, close to 40% of the portfolio, 37, 38%. And then in our global multi-asset model, where thematics makes up about 30% of that model portfolio, the bulk of that thematic exposure is in the climate ETFs, because as we've said from the beginning, climate is the macro trend of the 2020s, because every single government in the world is spending money on it. It is spending money on it over the next 10 years, and there's nothing else that you can kind of put your hands around that comes anywhere close to that kind of spread of importance. And so that's why we are focused deeply on it at TPW Advisory. And our view is that this is a good step forward, and it's not the only step forward. I mean, the other thing we highlighted in the monthly was the growing acceptance of nuclear power as a baseload provider, and noted that even in Germany, where resistance to nuclear power has been a driving force for the Green Party since the 80s, even the Greens have now, I saw a poll today that 68% of Green Party members, so not just Germans, but Green Party members, agree that nuclear should be kept going for at least the near term. And so this is a big shift, and it's being driven by conflict. So remember, a key focus for us is the 3 C's of COVID, climate, in conflict. In nuclear power, you see the two, climate and conflict, coming together to influence nuclear power and the acceptance of nuclear power, even amongst people like the Green Party, who have been totally against nuclear power for almost the entirety of the party's existence.
Yeah, actually, the Green Party, they have started as an anti-nuclear party.
Yeah,
That's a very existence. So, I mean, I talked to to German friends and and analysts, and I say, okay, I mean, even given what happened to the technology, and how much safer nuclear has become, I mean, don't they change? And then they say, no, no, it's different because it's their DNA. It's part of it's built into their DNA. How can they change?
yeah, and they can change because the other option is submitting to Putin's blackmail. So I
Or
mean,
coal, which is worse. I mean,
again, it's an
yeah,
example of kind of how Putin has outfoxed himself. He's gone so far in the wrong direction that he's been able to convince the Green Party that they should accept nuclear power. I mean, that's like, as you say, it's unheard of almost, but it
yeah,
shows you where we are. I mean, Germany is truly between a rock and a hard place. Has to make some major changes to its whole economic model to be able to be successful in the next 10 to 20 years, right? The last 10 to 20 years really played into Germany's strengths. The next 10 to 20 years, Germany really has to make some big moves to deal with the fact that cheap energy is no longer viable. Their manufacturing expertise is becoming less valuable as more things move to digital. The whole movement to electric vehicles, et cetera, et cetera. There's a lot of stuff, I think, that is going to need to change in Germany. And one of the drivers to that change is the fact that there's virtually no other option. And so it's the European story writ, kind of in miniature, right? Europe tends to dither, not much gets done, but then in crisis, Europe is able to achieve significant outcomes. And so
yeah.
now it's Germany that's in crisis, and it needs to leverage that crisis to make some significant changes to its model. And so certainly, as someone who's probably more constructive than most on Europe and European assets on a strategic basis, we've talked about this, many times. I see it as a real potential winner in the tripolar world over the 2020s. Germany and its ability to make these shifts is going to be critical to that.
Yeah, it's interesting. You mentioned that point. I mean, in the last 20 years, everything went right for Germany, and I think Germany is the only country in the West, the whole West, where which is better off in the last 20 now than 20 years ago, because of course, Asia is much better off than the West, with the exception of Germany, because they had cheap Russian gas. They were selling, machinery and high value added goods to China, which now China is making some of those goods, themselves. And also, they had the help of the euro because they went into the euro with an undervalued currency, with an undervalued Deutschmark. So they had everything working for them. And now, it's not the case anymore.
Yeah, there are challenges there for sure, and but the fact that the Green Party has the flexibility to move in this direction, is a good harbinger of the future for Germany, hopefully.
Yeah, no, it's and I agree, and I think of course, it's I mean, as they say, necessity is the mother of all inventions. So now they do have to change. And plus there is the fact that the backbone of the German economy is the internal combustion engine. It's not even the car. I mean, it's the ICE. So with and that's going to be forbidden in Europe in 2035. So they have to get moving.
Yes, and this goes back to the point about why you have to focus on climate
Yeah,
as an
absolutely. Yeah,
investment. You have a set date, 2035,
yeah,
where things have to change, and that's why Volkswagen is moving, so aggressively. And this is the whole electric vehicle battery production, right? And producers and battery, car producers and battery manufacturers coming together, Panasonic linking up with different people, setting up production in the Americas, in Europe, in Asia. The climate process and the corporate reaction is really driving the tripolar world idea of regional integration. It's speeding that process up. And again, it gives me and us at TPW Advisory, a lot of confidence that our tripolar world framework is really the way to think about the world. And when you see the battery folks and the EV folks syncing up to have production in each region, that supports the regional integration thesis.
Yeah, we. I have an important question on inflation on a former colleague of yours from Morgan Stanley. So, but I just want to link what you said about your whole capex boom theory, because I mean, of course, it is related to that, right? Because it is related to climate to some extent. So you have the productivity boom that started with COVID, and now adding to that, there is this the need to act on climate, because we are seeing it's being rubbed in our faces every day.
Yes, no, this is the three C's as we've talked about: COVID, climate, and conflict, driving a global capex boom, important global, not just in the U.S., global capex boom that should unleash productivity, that then should again kind of allow the central banks to feel more confident about a high nominal growth rate environment. So this to us is absolutely key. We don't believe that we're going back to the pre-COVID environment of 2% real growth and 1% inflation, so 3 or 4% nominal growth. We believe we're going forward into a new world of high nominal growth, meaning 2 to 3% real growth, 2 to 3% inflation, so 5 to 6% nominal growth. And the difference between 3 and 4 and 5 and 6 is pretty significant. And we think that's the future as we see it, driven by the need to deal with climate, to deal with COVID, to deal with conflict, and all the issues that permeate that around reshoring, nearshoring, everyone wanting to make sure they have battery production, semi-fab production, et cetera, et cetera. You just look at Tesla. Tesla's the major, EV producer with state-of-the-art production in each region. And Musk just kind of doubled up on that over the last week or two by saying he plans to double their gigafactories over the next several years. And so you have the folks at ARC coming out and saying that this is really raising the stakes for Ford and GM and others to keep up with Tesla. And Tesla has that leading advantage. There's nobody else with the advanced gigafactories in China, in Germany, in the US. Everyone else is trying to play catch up. And, everybody loves to bash Cathie Woods. Everybody loves to bash Tesla. But, the EV revolution is for real. And things like, Europe saying no ICE at 2035, the US moving forward with its climate package here, it's pretty clear which direction things are going. And again, strategically, investors need to be involved, need to be aware, need to be involved, and need to understand how this is shaping not only policy making, but also corporate decision making.
Yeah, no, and this is great. And I'm interested now on the point that your former colleague Stephen Jen has made about inflation. I used to remember him, when I was on the sell side as well, and of course, a great guy. So let us know about what he said.
Well, yeah, Stephen is a great friend and a great buddy, and one of the one of the great groups I'm fortunate enough to be a part of is a group of former Morgan Stanley folks, half dozen of us that get together every month and kind of go around and talk about markets. Everyone's still active in the markets. And Stephen's one of those guys. And he wrote recently about the considerable output gap that exists in the global economy. And so suggesting that output gap should allow inflation to kind of decelerate once we get through all the uncertainties of COVID and climate and conflict, supply chain, et cetera, because there is more room to produce than the current production levels, which would suggest that inflationary pressures should be relatively benign. And so I thought it was an interesting point, and one I haven't really heard elsewhere. We're always on the lookout for different points of view that you feel have credibility. And so I think that's one to really pay attention to. And so, as I said, for us, we're shifting focus from headline to core. We're looking within core at housing and labor. Within housing, the dynamic has changed very dramatically. And within labor, it's that quits ratio, and the fact that the people who have been switching jobs have been getting the big wage increases that are elevating the earnings number, which is worrying the Fed. So as that quit ratio falls, and it should, because clearly the things are becoming a little bit more challenging on the job front, though still robust. As that happens, that should allow that core number to come in. And that, together with the desynchronized nature of the global economy, we touched on it a few minutes ago, China accelerating while Europe and the US slow. We think that's a real another critical factor that gives us a little bit more comfort on the global economy and the outlook, and thus the outlook for earnings than perhaps others.
Yeah. No, and we have 10 minutes left, so maybe you could use that time, to look at your conclusions, on the monthly using your global risk nexus. And then if we have time, I can go to one of the two questions. You're probably going to address those points anyway. So how do we stand today? Using your global risk nexus.
Well, we've covered the good news is we've covered a bunch of it, right? We've covered climate, right. We've covered economics, we've covered politics with the Biden win, policy. We touched on it. I think the potential is that we maybe get to a period of more benign policy making in the coming quarters and over the next year or so. We have our view of the high nominal growth rate environment. I think that's the real key to understand that we're not going back to the 2010 to 2020 period. And then I would just note on the policy front as well that, policy in the U.S. is tight, right? Tight fiscal policy. The fiscal deficit is going to be cut in half this year. Tight monetary policy. The Fed is probably the most aggressive central bank out there amongst the developed major CBs. While Europe has certainly a more loose fiscal policy with Next Gen and Fit for 55, both ongoing the next couple of years, together with the ECB that I think is going to be not as aggressive as the Fed. And then in Asia, you look at the Bank of Japan on hold. Remember 2 months ago, everyone was convinced that the Bank of Japan was going to have to crack and get off its yield curve control policy. And lo and behold, today I looked, the JGB 10-year is at 16 basis points. So no worries. And then likewise in China has abundant policy flexibility, both monetary and fiscal. And they've been, quite measured in their policy mix to date. but there's room for that policy mix to be accelerated, perhaps after the People's Party Congress this fall. So policy-wise, I think we might be exiting the period of deep, upheaval and uncertainty, ahistorical period, and moving into something that's maybe a little bit more traditional, which I think would be good for all of us as investors. And then, of course, we come, to markets, and they're, I think the key for us is that we do believe we're in a bottoming process for equities. The markets have derated, very aggressively. Another good chart we had in the monthly was, again, I believe a JP Morgan chart showing that the multi-asset drawdown year to date, has been the second most aggressive in the last 30 years. We highlight the importance of the earnings bridge. We wrote about that before we went on vacation.
Yeah.
It's really important to us. And so, we talk about the tell that we articulated at the time, where the first in China tech and the innovation stuff bottomed first, right? China tech bottomed in April. ARC bottomed in early June.
Yeah.
We're now in approaching mid-August. So those, the traditional first in, first out is working. ARC was $50 today. I think the low was 36. I think the low on KWeb was around 20. It's come in a fair bit, but it's at $28, $29. So to us, technicals have gotten better. There's more work that needs to be done, but I notice even in looking at our positions, a number of them are now back above their 50-day moving average. Some of them even back above the 200-day moving average. And so things have gotten better. And now we're, maybe in a period of some digestion. Excuse me.
Bless you.
No, just that when I talk for a while, my throat gets very dry. And I think the other point, and you and I were talking about it before we went live, is that, the smartest guys in the room got caught out by the action in June and July, right? There was a good Bloomberg article. Yeah. I tweeted it out about how the best and biggest, long short funds in the U.S. Sold in June, did not get back in July. And so they didn't capture any of the up move. And I think that speaks to, how shaken markets were in June. And to me, that's another kind of arrow in the quiver of the idea that the June low might end up being the absolute low for this cycle. And if we're able to avoid a Fed that is overly aggressive, then we don't have to see a big earnings drop. And then we look back in hindsight and note that June may well have been the low. And I think, as I said, the high nominal growth world that we are in gives us comfort on that earnings picture. And so, to put it all into, portfolio terms, we continue to be overweight equities. We are underweight fixed income. We like high yield. That people are starting to come back to high yield. I noticed, I think KKR, one of the big private equity firms, just came out with a table pounding buy on high yield in the U.S. We like high yield as well. We feel like you're getting compensated for risk in a way that's fairly unusual with the spread. There's no default cycle ahead that we can see, and there's no repayment mountain ahead as we can see, because people tend to forget that everyone refinanced last year and the year before. So the refi mountain for high yield is 2023, or actually more like 2024, not in the near term. And that's when high yield tends to become a problem, right? When there's a big need to refi and the market's closed. the opposite. The market is kind of closed now. There's been virtually no new issuance. But what that means is that the managers are collecting the dividends every month. Cash is piling up, and there's no new issuance to put the cash to work in. So what do? They buy existing issues, and the price goes higher. So we prefer high yield to sovereign. Don't really see with our view of the high nominal growth world. We don't really see much attractiveness in a 10-year treasury at 2.7%, or the bond at 0.9%. We continue to like commodities. Again, everything goes back to that high nominal growth rate world. That's our kind of central tenet. And so we like commodities. We think the action and the volatility in commodities over the last month or two is driven in part by the fact that there was a lot of financial speculation that went into the physical commodities because of the Ukraine invasion, right? All of a sudden you had the traditional commodity guys, and then you had all the financial guys piling in and now piling out. And so you have, a pretty sharp drop in crude, a sharp drop in copper, coupled with the lockdowns in China. But I'd note that copper is now up 10% off its low of about a month ago. So signaling maybe better days ahead and maybe the end of that, selling of the financial speculators. And so all that, plus the improving technicals and stuff make us, reasonably constructive. I mean, now we have to see, how the markets handle Wednesday's CPI. And then what are we going to hear from the Fed in Jackson Hole in a couple of weeks? But there's a lot of time between now and September when the Fed meets again and likely to raise rates again. But the market is kind of priced in that, Fed fund future rate around 3.5%. So another 100 basis points. And then I think, as I say, if we're right that inflation falls off quickly, that gives the Fed more time. The earnings bridge helps us in the interim. High nominal growth suggests that even if we continue to see higher rates, we don't have to go into a deep recession or even perhaps a mild recession. And that kind of allows us to be, somewhat more constructive on risk assets than others would be who don't share the same view on the nominal growth rate world. And that's kind of where we are. We're feeling pretty good about the climate position, particularly in the thematic space. I think one of the big questions out there is growth versus value versus defensives. And we have been a big proponent of value, and that worked well. And then over the last couple of months, it's worked less well. We were able to get back into some growth names, cloud computing, for example, 5G, for example, with the tail of the bottoming of the innovation space a couple of months ago. So those were things that we added to our multi-asset model. And I think, where we're at right now is that we prefer either growth or value more than defensives, because defensives have gotten very, very expensive, and to us are not really attractive, again, given our view. So a little bit more balance between growth and value than maybe we were 6 months ago, and like either one more than defensives.
That's excellent. We are 5 minutes, beyond the mark. But thanks again, Jay. This was excellent. We covered a lot of ground, as usual, and we'll see each other in 2 weeks. So welcome back from your vacations, and stay safe.
Excellent. Yeah, thanks, Roberto. I didn't mean to go over. I guess.
No, that's great. It's our benefit, our privilege.
Excellent. All right. Well, thanks again, and we'll see you in 2 weeks.
See you in 2 weeks. Thank